All right, let's start the class. So today, of course, we are having we are not supposed to have a session today, but because of the one short week we have in the semester, so we are using this holiday week to make up for one session. So what will happen in terms of if you look at if you're trying to map against if you're mapping against what is there in your, this handbook, right? If you're mapping against this, what you have is that we are pushing the whole thing forward by 1 week. So in this week 6, there was supposed to be a class test. This will happen on Friday, but there's not supposed to be a class, but we are pushing this week 7 into this. So everything is getting pushed by 1 week. So when you have your last class, because here there is no opportunity for revision here, so this revision gets pushed forward into week 11, because week 12 is already your exam week. And I don't know, Duffy has not yet told you, but the exam, we are not supposed to tell you the exam date, because Duffy is supposed to tell you that. But the exam date has already been announced, okay? So anyway, starting from this 18th week of 18th May. So that's the situation. So if you want to keep track of what we are doing, we are just pushing the whole thing up by 1 week. If you refer to this, you'll understand. So we're going to follow the same schedule, all right? Okay, so let's start. This is a very big chapter actually on capital gains. So let's start that. Capital gains tax. I think we'll have to switch. All right, let's try to. So please make sure you read the way to cover most of these topics. You don't really have that many topics. You have the introduction. So far we've done basically 3 topics. If you include the NICs, or 3.5 topics. If you say the NICs are like half a topic. So we've basically done the introduction, then we did the employment, and then we did self-employment. And then we did NICs, which is like 3.5 topics. And then after that, you'll have just corporate capital gains, corporation tax. So now that you have you have the book, so please refer to the book always, because sometimes the book will have a better explanation of things than what you see on the slide. So it's when you're studying, it's better to study, have the slides, because the slides give you some idea of what is important and what is not important. There are a lot of things covered in the book, some of which are not important for the exam. So it's not covered that much in the slides, but some things which are covered in the slides, there is more information in the book. So always read with the textbook, even though it's like 1 year back, but still, other than the rates and all, a lot of the theory is still, the book is really helpful if you read the book, okay? So, right, so all these chapters, so please make sure you have this. I gave you the contents page as well. So, yeah, okay, so let's look at it. Okay, so what happens in the case of capital gains? We are talking about, you're going to tax. Capital gains usually is what we charge for whenever you sell a capital asset. So remember when we were doing employment, we were doing self-employment. We looked at capital assets, and so generally under accruals basis, we would not allow any kind of deduction for capital assets. So the idea there is, so capital assets, things which lead to an increase in your productive capacity. So those kind of assets, when you make a profit on the sale of those assets, you have to pay capital gains tax. So in many countries, there's a different rate for, most countries have different rates for capital gains tax. Some make a distinction between long-term and short-term capital gains tax. They are treated as different from the income tax. So you need 3 conditions. Basically, it has to be a chargeable asset. It has to be a chargeable disposal. Disposal means, generally in loose terms, it will be sale. But it's actually, the meaning of disposal here is a little broader than sale. Even gift or even the destruction of the asset is considered a disposal. So, but generally by disposal, what we understand in layman's terms is just a sale. But this one, be careful here, the meaning of disposal is broader than just that. Then of course you have to have a chargeable asset. So chargeable disposal, chargeable asset, and a chargeable person. So all 3 need to be satisfied. So a chargeable person is someone who's resident in the UK or ordinarily resident. This is another resident residency sort of test, we don't have to worry so much about the residency part of it. We just need to know that people resident in the UK. So the UK has a pretty harsh tax regime, which is one of the reasons why their economy is not doing well. Overtaxing, basically, as I pointed out to you. So they basically tax, if you're a UK resident, you get taxed on your global income and you get taxed on your global assets, like on your capital gains. If you have, let's say you're a UK resident and you own some property in Singapore and you sell that house in Singapore, you make a profit, you have to pay tax on that profit to the UK government. It doesn't make any sense, okay? So but some countries have that, and so the UK is paying the price for its insane tax policies, and their economy, as you can see, is not doing very well. So anyway, corporations, when they have capital gains, that will get covered under corporation tax. Okay, so let's see, what is a capital gain? Chargeable disposal. So these are different types. So this is the expanded meaning of disposal. So as I said, normally disposal we understand just a sale, but sale or a gift of whole or part, any exchange, loss or destruction. Okay, if you die, there is an exemption for that, for capital gains, but then you get into the inheritance tax. That's another funny tax they have in the UK, which many countries don't have. So the UK's got taxes everywhere. Okay, so chargeable assets. So all capital assets are chargeable, and what is not chargeable? Everything is chargeable except for the statutory exemptions. So you need to remember these statutory exemptions. So as I mentioned to you also, that when you look at any kind of so when you're studying any particular topic, right? So we only have so few topics. Okay, after this we have capital gains, then we have inheritance, then we have corporation tax and VAT. So we'll have about 7.5 topics if you think about it. Okay, so when you're studying from the textbook, always make sure you study with the textbook, also referring to the textbook. And whenever you see all these kinds of exemptions, okay, like here we are looking at exemptions, please prepare short notes, because like somebody asked a question on the group about whether there'll be text questions. Yeah, as you can see in the case of Bob also, that question 30, Bob, like there's a question on the dates of payment. So similarly, there could be all kinds of questions like, what are the types of exempt assets? I'm just giving an example, okay? So under capital gains, there could be a question on what are the types of exempt assets. So we should be referring to the book and referring to the slides and making a short notes of that. So when you study by topic, and each topic you can also not just do the calculations, but also do the narrative questions, because this could be a narrative question for maybe 2 marks or 3 marks. What are the exempt assets? I'm just giving you an example. So when you study the book, just develop a feel for what could become a question, what could become a narrative question, and make a short note of that, and then try to memorize that. And whatever you can remember, at least even if you can't remember everything, you may write some things, and at least you get a few marks, okay? But at least be mentally prepared for those kind of questions, because most of the questions formats are going to be like that. There will be a big chunk of calculations. So question might be like 15, anywhere between 15 to 30 marks. And so there'll be a big chunk of calculations, and then there'll be maybe 3 to 5 marks narrative questions. And then we know topic 2 will have a 15-mark narrative question on tax and ethic. We know that is coming, right? 15 to 20 marks is coming. So those kind of things. So please don't forget to prepare your essay questions also. Keep preparing short notes for yourself, and then that'll be much easier to answer in the exam. Okay, so these are the various types of assets which are exempt. Okay, vintage cars. So sometimes, very often you get questions on cars. He sold a car. So cars are all exempt, okay? So cars, so sometimes they say he sold a vintage car, that's all exempt, okay? Then there's a special rule for chattels, which is any kind of movable property, okay? Tangible movable property less than 6K. Then NSCs and bonds in individual savings account. If you remember from income tax also, ISAs are exempt, okay? So betting proceeds are also exempt in the UK from capital gains tax. That's why they have a very well-developed betting market in the UK. So disposal between spouse. Here, this is not really exempt actually, But disposal between spouses, we just consider it as there is no gain or no loss. Okay, strictly speaking, it's not exempt. It's actually treated as no gain or no loss if there is a disposal. Okay, so we are going to calculate. So we're going to have. So typically, a question will have different types of assets. So he had a old Ming Dynasty vase. He sold that vase, made some money. Then he sold a non-principal. He sold a second holiday home, made some money there, and so on and so forth. And then he sold a painting. So there'll be questions on different types of assets. Most questions will have different types of assets, and there'll be transactions. So you got to show each transaction. Better to keep a box. Just use a pen and make a box, and put the calculation for each asset in each box clearly. And then, so you have to calculate the gain and loss on each asset separately, and then you have to add up the profit and loss, and then you have to deduct the capital losses brought forward. Then there is an annual exemption. There is a 3,000 annual exemption, and then you can calculate the capital gains tax at 18 and 24. This, of course, is given in your tax tables. So if you see here, so in the information in the tax table, so always make sure you are familiar with that. So we have simplified the system. Last year it was a little more complicated. So there is something called a business BADR. This is called BADR. Business Asset Disposal Relief. So here you get a 14% tax rate, okay, and this doesn't matter where you are in terms of tax bracket, you still get a 14% tax rate. And this 18% and 24% is just like your dividend income, okay. It should have been written like this, that ideally what it should have been is, just like I told you, that the dividend rate should actually have this. The dividend rate should have had this picture over here, dropped into this over here, but I have done it on your in your spreadsheet file, right? The student spreadsheet file. This picture should have been dropped into this, because these rates are actually corresponding to this, and this. Okay. So similarly, in the case of property, in the case of capital gains as well, we don't really care about this one because there are only two rates. So if you're in this band, you get one rate, which is the 18, and then if you're here or here, it doesn't matter wherever you are, it's 24. So moment you cross over this one, you get into 24, and then you're at 24 throughout. So all that is written over here. So mentally you have to, where is the capital gains tax? Oh, here. Capital gains tax. So mentally you have to drop the first income tax band, that is 0 to 37.7 here, and then 37.7, anything more than 37.7 this is the basic rate. So this is also not written here, so you have to imagine there. So this is basically the system, okay? And if it is a type of transaction which is eligible for the BADR relief, then you can identify that as a BADR relief. Then you don't have to pay either of these. You only pay 14%. Okay, and there is a limit for that. This is £1 million per year. It's a lifetime limit actually. So if you use it once, it gets used up, and you have only a little bit left for the balance. Okay, so just remember what is there. So then you don't have to remember that. Okay, here. So there's the annual exemption that is mentioned there. You'll see annual exemption is 3,000. Okay, that also has been cut down over time. So if you look at UK taxation, over time it's becoming more and more burdensome. All the reliefs are getting cut, and by and large, there's some relief for businesses, but by and large, it's for individuals, it's becoming more and more burdensome, which is why you'll see that a lot of very rich people who used to live in the UK, they're all leaving. They're going to Italy, they're going to Dubai, they're going to Switzerland. The UK is losing a lot of very rich people. So it's again, that's a warning sign for any economy. So anyway, so that's basically what's happening. So it helps you to understand that tax policy has consequences, right? If you have very burdensome tax policies, then you're going to cause rich people to leave, and the rich people, it's not just they're rich; they're actually usually businessmen, so they create jobs. So it has a negative impact on the whole economy in general. Okay, so these are the steps. We need to remember the steps, and we need to remember the pro forma. There is no pro forma given for capital gains in a spreadsheet form, unlike what you have for the other types of topics. There's no, but you got to get the pro forma from here, okay, from the slides. You got to basically, you can put this into a spreadsheet also, and this is your pro forma. So first you look at any disposal proceeds, whatever you get. Disposal proceed means whatever you get from getting rid of the asset. Either you gift it, or you sell it, or you sell part of it. Then allowable selling costs. So generally here again we'll follow the same rule, that is whatever we were following for the business rule, which is wholly and exclusively for the purpose of the business. By and large, if you follow that principle, whatever is allowable as a selling cost is basically the common sense idea is that whatever you needed to spend to make the sale. Let's take a simple example of a sale. So if I'm selling a painting, maybe I'm selling a painting in Hong Kong. Hong Kong is a very active art auction market. So let's say I'm giving the painting to Sotheby's in Hong Kong. So they will auction the painting. And so when they auction the painting, obviously the auctioneer is going to charge a fee, right? You remember we discussed auctions last semester when we discussed the contract terms, the finalization of contracts in auctions, that the auctioneers, the acceptance, we discussed it in the context of acceptance, where the acceptance is not complete until the hammer comes down. So the auctioneer tells you 3 times and then brings the hammer down. So we did this famous case called Payne versus Cave. So anyway, so if you're selling a painting in an auction and you have to pay the auctioneer some fees because he's going to take a commission for performing that service. Now obviously you could not have sold that painting without paying that auctioneer, right? So that cost is going to be deductible because that is wholly and exclusively for the purpose of making that disposal. So anything like legal costs, auctioneer's fees, any other kind of broker fees, agent fees, all those kind of things which will be understood as essential for making that disposal. So that'll be covered. Okay, then that's your net disposal proceed. Then you have what is the allowable expenditure? What is allowed? Cost of acquisition. Okay, so you're going to deduct from the thing, you'll deduct the cost, whatever you bought it for. And then the incidental cost of acquisition. So this is actually very similar to this, you see. So it helps you to remember this allowable selling cost and this incidental costs are basically conceptually the same idea. That whenever you bought the thing, whenever you bought the property, maybe you bought a house 15 years ago, but even when you bought it, you would have paid some fees for the agent, right? The agent will take some commission. All that, of course, you could not have bought the house without paying the commission to that agent because let's assume you can't find that house on your own. So that means the agent fees are essential part of making that acquisition. So that under that same principle, so we are applying the same principle here. So it helps you to remember when you look at the thing, even if you forget the exact pro forma, you can apply this general principle that logically whatever is essential for that transaction is going to be allowed. So incidental costs of acquisition, exactly like this, will be also allowed. And additional capital enhancement expenditure. So if you remember we were looking at certain types of, like we, in the previous topic in self-employment, or the one before that, self-employment, we looked at one example of law shipping company versus CIR, where we looked at the repairs, where they called it repairs, but actually there was work done on the ship. When they bought the ship was not in seaworthy condition. So they had to do some additional work on the ship to make it seaworthy. I mean, what is the point of a ship if it can't sail, right? The whole point of a ship is to make it sail. So if it's not worthy of, if it's not seaworthy, then it's not really a ship at that time. So you had to do some additional work on it, and then you called it repairs, but they did not allow it because of the language that we saw, that it was necessary to do this additional work to put the asset into usable condition, which means that before that it was not a sufficiently productive, it was not a good enough capital asset. So you did some additional work, and that was basically therefore treated as a capital expenditure type of work. So that will not be allowed as a deduction under accruals basis. I'm going back to self-employment now because you have to be able to connect all the topics as far as possible. So that, but here, why am I giving that example of the law shipping company versus CIR? That is because that will be treated as, remember, that was not allowed as a deduction. So what happens to that amount? That amount gets added as a capital expenditure. So you can add it to the value or the carrying cost of that asset. And you add it to the carrying cost, and later on when you sell that asset, later on if you sold that ship, that work that you did on the ship, that will get included. You'll get the benefit of that. How? By adding this to the allowable expenditure. Additional work done on it, that will get also counted as allowable expenditure. So all these things will be deducted. So you deduct this. This is like your gross profit. If you think about your standard income statement, this is like a concept of net disposal proceeds is like a gross profit on any transaction. And then you have the other, the other types of expenses which are allowed. And then finally end up with a chargeable gain loss. So you do this pro forma for every asset. So which means that mentally you should already have this in your mind. Every question you're going to get is going to have like 3, 4, 5 different assets. Okay, he sold a vase, he sold a property, he sold something else. Then they'll throw in some car, vintage car. He sold a vintage car. Don't include that because vintage car you have to just write as exempt. Okay, so then for each of those assets which are being sold, you should just make a box and do the calculation for that asset in that box, and then take the total here, this gain loss, this chargeable gain loss, take that for each asset and then add it up, A plus B plus B plus C, etc. And that will give you your total chargeable gain. And from there you'll deduct the annual exemption first, and then you'll think about the other, then you'll see where it is in terms of which rate has to be applied, 18 or 24. All right, so pro forma given there, you have to apply that, as I said. Okay, market value or actual value. Okay, so that depends on whether or not it's an arm's length transaction. Have you heard of this expression, arm's length transaction? Yes or no? No? Okay. Arm's length transaction means I put in something, again I put certain things here. Now these numbers may not be right because the book has changed, so the page numbers may not be correct, but I've tried to, this is just on the, what are the subtopics covered in the slides. Okay. Now step 2.5, where's slide 6? Okay, those are the reliefs. Okay, fine. These slide numbers, okay. Let me look at, so that I said here, per asset chargeable gain is net disposal proceeds minus allowable expenditure. This is just a pro forma. Okay, the net disposal proceeds is gross disposal proceeds less allowable selling costs. Allowable expenditure, I've just summarized that slide there. Okay, now what is an arm's length transaction? Okay, so this is something that, again, you have to be very familiar with, where because this becomes very important in taxation. So later on when you do international taxation, have you heard about transfer pricing? Have you heard this term called transfer pricing? Yes or no? Anybody? Transfer pricing? No. Okay, so that's another term you need to be aware of. That comes up in international taxation. Because as an accountant, you should already be studying these terms on your own, even if it's not in your syllabus, okay? So, so arm's length transaction means essentially, is it like the related, another connected terminology is what we call related party transactions. You'll see that in corporate law, when we were talking about directors, we had some discussion on related party transactions, which means that if you're doing transactions where maybe you're selling some company property to your twin brother, okay, or your sister or something, or your mother, now those are considered, right, I mean, basically related party transactions are broader than that, but those are not considered arm's length. Arm's length essentially means like this is my arm's length, which means it's trying to indicate some distance, okay? So if I do a transaction at arm's length with someone, that means it's like this arm's length is meant to show some distance, which means that person is not like my mother or my sister or my son-in-law or something like that. So they're not part of the family and business associates, those kind of close connections, because that means that arm's length means they have a distance. So they are just some random guy on the street, or somebody, the broker brings me somebody to sell my house to, and I sell it to them. So I don't know them. I have no reason to give them any kind of favors. But the idea is that if this transaction is not at arm's length, if it's like my sister or my brother or my mother, then I have an incentive, because they are part of my family or my business partnership, okay, my business partner. Then I have an incentive to give them a good deal. Like I don't have to sell it to them at market price, okay? Which is why, if you remember the same idea, when you go back to property rentals, remember we discussed non-commercial property rentals, right? What is the idea of non-commercial? That moment you let the property to your sister or your brother or your father or someone like that, that is not considered commercial renting, because it is part of your family and your known group of people. So that means we expect that you will probably not charge them the market rate of rent. All right, so that's why we don't allow losses on. We can have zero income, you can have zero profit, or you can have positive profit, but you can never have losses on non-commercial properties, because of this suspicion that we have, that because it's not an arm's length transaction. So that was also an example of, essentially, we didn't use the term arm's length, but that was also the same idea. Arm's length essentially means that if it's at arm's length, it indicates the distance, which means it's not a person close to you. So the idea is that if it's an arm's length transaction, it is likely to be done at market prices, because if I don't know this person, some guy comes to buy my house, why should I give him a good deal? I don't know him, so therefore I'm more likely to sell the house to him at the market price. So basically the question is should you take when you are looking at the value of the disposal, right? How much should we take as the disposal proceeds, the gross disposal proceeds? How much should be the gross disposal proceeds? Remember, this net disposal proceed here is what I'm calling, because we are calling it net disposal proceeds here. So this one I'm calling gross. In my notes I just called it gross to make a distinction, gross minus net. So the question of actual transaction value, or actual transaction value, or actual gross disposal proceeds, or should we take the market price? That question arises, that's where this concept comes in. So if it is an arm's length transaction, then we just look at the actual disposal proceeds, because we assume that because it's an arm's length transaction, there is no reason to do the person or the counterparty any favors. So it's most likely that it went through at market prices anyway, right? Because the idea is we always want to capture the market price. So in the case of a transaction which is at arm's length, we take the actual price, because we consider, why do we take the actual price? Because we think that the actual price is likely to be the market price. Okay, so ultimately our focus is always on the market price. And in the case of an arm's length, a transaction which is not arm's length, selling my house to my mother, okay, that's going to be suspicious. So in that case, they will take the market price. They'll figure out a way to find the market price of the house, and then they will take that as the gross disposal proceeds. This is clear? Yeah? Okay, so you should learn certain terms here, and you should also make the connection to what we saw in non-commercial renting. The more you connect the ideas, the easier it becomes to remember everything, okay? To always try to connect ideas whenever there is a logical connection. That's why I reminded you of non-commercial renting. Non-commercial renting, we don't allow losses. Why? It's the same idea, because those are not really arm's length transactions. And so therefore you're not likely to use a market price or a market level rental. And that's why we are suspicious, and that's why we don't let you claim any losses. So this is the idea. So these are called a transaction which is not at arm's length, okay? Is basically considered, there's another term that comes from corporate law, okay? Roughly equal to, okay? I will say approximately equal to not arm's length transaction, Okay, so any related party transaction, this is discussed, this term is normally used with respect to company directors. And but it's the same kind of idea. The main idea is that it's not an arm's length transaction, right? So okay, so that's basically it. So this is just a rule for that. Okay, so yeah, what should we use? Okay, so family, business partners, company. This is where if you see anything like that, then it becomes not at arm's length. Okay, and in that case, you have to figure out a way to use the tax. So in this case, the question will actually mention that this guy sold the house to his father, and the market value of the house was assessed to be some amount. So you don't have to figure out the market value. That will be given to you, and they will give the actual price of the sale also. So that's where you have to figure out that if he sold it to his father, that means it's not an arm's length transaction. So in that case, you have to use the market value, which is given in the question. Okay, so I told you auctioneer's fees, legal fees, all this stuff, advertising, all these you'll see sometimes advertising costs given. Yeah, why is advertising incidental costs that is allowed? Because if you didn't advertise it, how would you have sold the asset? You had to advertise, and that's how you got potential buyers coming in. And so advertising is also considered acceptable as a deduction. Allowable expenditure, okay, the purchase cost, incidental cost, and improvement expenditure. That's what I show you, that law shipping case, which is a good thing to remember. And that also helps you to remember something else, that those kinds of additional work done, which are essential to make the asset functional or make it fit for use. It was not usable until that work was done. Straight away you know that expenditure will not be allowed under accrual accounting for self-employed, because that will be considered a capital asset. Okay, so okay, let's go here. Let's see, chargeable asset. This is an example. Okay, so you see that they bought it. The cost of acquisition was 15. Then so now you're adding another 500 to the cost of acquisition. The incidental cost of acquisition is 500. Then enhancement expenditure is 2,000 and 3,000, so that's 5,000. Then they sell it for 28, and then while selling they have 700 of incidental costs of selling costs. So basically, what will this get done? How will this get done? You see here. So we can't see the initial information, but you can see that. So first you take the gross sale proceeds, then from there you deduct. So, and this doesn't mention anything about the related party transactions or anything. That doesn't mention that it's not arm's length. So we assume that it's arm's length. If it's not mentioned, we assume that it's arm's length. Otherwise, it will mention something in the question that he sold it to his sister and all that. So in this case here, sale proceeds, the gross sale proceeds less this becomes net sale proceeds minus allowable expenditure. Okay, so always remember this framework. That's why I gave that framework in your slide here. Okay, in your notes. I think which slide is that actually where we have the framework? It's actually, yeah, it is slide 7 where we have this framework. So I just added some additional terminology. So gross disposal proceeds less the allowable selling cost. Right, so we got this kind of transaction here. Now you see, so you gross sale proceeds minus this allowable selling costs. That gives you the net sale proceeds minus all the allowable expenditure. What are the allowable expenditures? Acquisition costs, incidental cost of acquisition, then enhancement expenditure, all that you add. So you basically get 15,500, 20,500. From there you deduct from this, you deduct this 20,500, and that's your chargeable gain of 6,800. Okay, and this is for only this asset. So in the exam you follow this format for assuming that, let's assume that you had like 4 or 5 of these types of transactions with different numbers. So for each transaction, just make a box and do this kind of calculation, all right? And then you have the total at the end, and then you're going to add up all the totals and see what the net figure is. Okay, so 3 to 5 calculation of which 3 to 5 are they referring to? There's no step 3 to 5. Annual exemption. Okay, fine. Annual exemption, as you said, there's a 3,000 annual exemption, and the rates are also. You don't need to mention this. You don't have to remember this. So one thing you need to remember is that if there is no information as to whether the person is a higher rate taxpayer or a basic rate taxpayer, which is basically this one, right? Here, are they here? Are they in that first block, 0 to 37, or are they in the higher? So maybe what I can do is I can take your thing. Let me just go to the topic 1. Topic 1. If I go to topic 1, now again, many people have opened this. They should not open it. What we can do is we can take this one and maybe copy it here. So I wanted to give this clarity for your dividend income. We can do one more thing actually. We can bring it to capital gains, and maybe we can write it here. So we have to move down a little bit. We can write it as, okay, so this one, what are we saying here? Dividend income tax here. We can just add one more, right? We can basically add here CGT, right? And then we can just write we can take copy from here and get the format at least. So we don't need this third one actually, we just got 2 of them. So this will be 18% and this will be 24%. Okay, now that there is a BADR which you have to remember, okay? I'm not writing that because the BADR is, we don't have to write in this format, in this schema, because the BADR doesn't depend on where you are. You know, even if you are at, again, somebody has opened this, please don't open this when I'm teaching in the class. This is meant for you to open when you are at home. Okay, so this one will of course not be there. The BADR is not a function of where you are in terms of your income levels. So this is basically looking at your taxable income. Okay, so for this basically you're looking at your taxable income. So all of this is looking at your taxable income. So we can write this as taxable income. So if you see here 18%, 24%, this is what it means, all right? Sorry, what have I done here? So I've done it the other way around. I've done it the wrong way. I've not written it the right way. So we start with the lowest slab. So this one should be here actually. So good thing I looked at that. Now it's okay. Okay. So yeah, and this one also, you are everywhere you go, you are still at 24. We can just write this one here. Okay. It's always 24. So that's it. Basically, it's the same thing. So from the lowest one, actually, I did it this opposite way. So 20%, whatever is the income tax rate is 20%, for dividend rate is this, and for capital gains is this, okay? And so for capital gains, we can give it a different color, just to make it look interesting. Yeah, okay. So we got a different color there. Okay, so that's your dividend income, the normal income tax, and the capital gains. Yeah. 1824, that's fine. Okay, so that's basically what it is. Okay, so to give you more clarity compared to the tax tables. Okay, let's move on. So this you don't really need to remember because it's there. So only thing you need to remember is that if nothing is mentioned, then you got to assume that it's a higher rate taxpayer, so 24%. Yeah, so this what happened last year we don't know. So it's been simplified. We don't have to worry about last year. We only worry about this year. Okay. So if you have a net loss for the year, what happens? The assessment, just like your property income, which we discussed, where you have the income will be shown as nil. You don't show the negative income. And then what happens? You lose your annual exemption. So there is an annual exemption of 3,000. So if you would normally, if you had a gain of say 7,000, if you're adding up all the assets, and you have your net chargeable gains is 7,000, then you would then apply the annual exemption, which is 3,000. So you would end up paying tax on only 4,000, okay, of capital gains. But in this case, if you have a net loss, then you lose the annual exemption. Then you can take, you can use carried forward losses. So if you have a loss, you can't just reduce it to the annual exemption. You have to take out the whole loss. then when you're bringing the losses forward, so if it's a loss in the current year, you have to take all of the loss. But if it's a brought forward loss, then you can reduce it to the annual exemption. You can use part of that loss. This is the idea that basically, this is an important idea here, that if you have a loss in the year of the loss, you can't take part losses. You have to take the whole loss. But if it's a carried forward loss, then you can take part losses. And you can carry it forward indefinitely. All right, okay, what else? Yeah, okay, so this is the high level calculation. So the pro forma I showed you earlier is for each asset. We saw that earlier, which is you have gross disposal proceeds, allowable selling costs, net disposal proceeds, less allowable expenditure, which consists of cost of acquisition, incidental costs of acquisition, and additional capital enhancement expenditure. Add up all those three, you get the allowable expenditure. You deduct that from the net disposal proceeds, and then you get the chargeable gain or loss for that asset. So those are for the individual asset boxes. Now this is your high level calculation, which takes the final total from each of the asset boxes, and then comes out with you add up all of them, right? And there might be some losses, so the net total will be less. And so you add up all of them, you get the net chargeable gains for the tax year. From there you deduct the capital losses brought forward. Then you deduct the annual exemption. Okay, remember that this year's losses are already factored into this one. The net chargeable gains is already including it is the sum of the total figures for each of the assets. So some of them might have had losses this year. So that's already factored into this number. Okay, so the individual losses are factored into this number here. Then you take out the capital losses brought forward. Then you take out the annual exemption. Then you get the taxable gains. Okay, and then you find out where you are in the tax bracket. Okay, so this will be kind of tax lost. If you see, you start with the NSI. First we start taxing NSI, then we start taxing the SI, and then the dividend income, and then we can tax the capital gains income. Right, so rate we already have. Okay, now, so here's something you need to remember when we haven't studied BADR yet, but when we study BADR, you'll see this business asset disposal relief. So there is some concession being given to businesses, because if you have business assets, slightly favorable taxation for businesses, and so if you have business things which qualify for BADR, they will always be at the BADR rate of 14%, which is why I did not add it in that, this 14% I did not add over here, because that's not a function of where you are in the income tax slabs. Where is your taxable income, all right? So here we talk about mainly your taxable income is that, and remember what is taxable income? Taxable income is taxable income or TI is basically your net income minus the personal allowance. That gives you the taxable income. So don't compare the net income to these numbers. Okay, you have to look at the taxable income figure. All right, okay. So if the taxable income year exceeds basic rate band threshold, right? So if you exceed the basic rate band, if your taxable income is over the basic rate band, that means your taxable income is here. Okay, if your taxable income is here, then anything which is not BADR, because BADR is 14%, will be taxed at 24%. So that is quite obvious. We already have that from the schema here, right? We already have that. So that's basically what it is. Now, here's the thing that you really need to remember is that if the taxable income is less than the basic rate limit, okay, whatever is left, so suppose the taxable income is say 25, okay, Suppose the taxable income is 25. So in this case, it's okay. We have a 5-minute break. All right. Okay. Let's start again. Where were we? Okay. So this is the part that I was about to discuss, which is there's one important thing you need to remember here. The other things which we already discussed, okay? Anything doesn't qualify for BADR. BADR is special. Now, if your taxable income is, I was going to discuss that if your taxable income is, say, 25. If your taxable income is 25, let's say, your taxable income is 25, just take an example. The TI is 25. And then let's say you have BADR of, say, 7. Okay, so what you have to do is you have to tax what this rule is telling you is that if the taxable income is less than the basic rate limit, which is the upper limit of the basic rate BRT slab, okay, the upper limit of the BRTS, then in this case that is 25, which is less than 37.7. Then the balance here which you have left, about 12.7, that you don't get to tax the rest of your capital gains, and let's assume you have you have capital gains now under whatever. Let's say you have capital gains of let's say you have CGT of 15. All right. So in this case it's 25. In this case your cumulative total becomes, you have to now basically, you already taxed this. Now you have to tax the BADR. This is what this rule is. And now you don't get to take your 15 and put it here and tax the balance, at least like 12.7 out of the 15 at the 18% rate. You don't get to do that because the rule is forcing you to, if your taxable income is less than the BRT upper limit, then whatever is left unused in the basic rate band has to be absorbed by gains which qualify for BADR. Okay, so basically, although the BADR rate is 14%, but you have to put the BADR here, which means that at this point, your cumulative income, and as I remember, if you remember, I told you that you always have to keep a mental track, and it's good to have a column in your calculation, and that represents the cumulative income charged to tax at each stage. As you move through the, as you are taxing each type of income, you should maintain a running total of the cumulative total charged to tax, because that helps you to see when you are moving into the next slab. You understand? Yeah, you have to keep track of that. So that now here you have 25 of taxable income. Then you are forced by this rule to use the balance of the BRT, the basic rate band. You have to use it for the BADR. So you have 7 of BADR, which means now your total income assessed to tax has already become 32. Okay, so that means you have only 5.7 left. You have only 5.7 left in the BRT in the basic rate band. All right. So your 15, the CGT, what will happen is 5.7 of that will get taxed at 18%. Okay, the 5.7 will be 18%. And the balance of the CGT, which is 15 minus, I'm doing everything in thousands, okay? So this, what is this? 15 minus, 9.3, okay? So that 9.3 will get taxed at 24%. Is this clear? Yes? Have you followed what I'm saying here? Yeah? In this case, where your taxable income is less than the basic rate band, the upper limit of the basic rate band, the balance that is left in the basic rate band first has to be used up by BADR. Whatever, so you have, let's say, 7,000 of gains which qualify for BADR. Then you have to, and here the rate will not be 18 or 24. The rate is always fixed, and that's given in your tax tables, which is 14%. So you don't have to remember that, but the BADR has to be put there. Okay, that's what this slide is saying. Okay. Yes, you see what is here. This is okay. So, yeah, gains which don't qualify for BADR are then taxed at 18% up to the basic rate band, and then at 24%. This is exactly what I've done here in this example. Okay, this example is exactly what I've done. So this is the CGT didn't qualify for BADR, and we took some of that here. So whoever's got this thing open here, please close it. Don't have this thing running in the class when I'm here. Okay, BRB limit if no gift aid is 37.7. Now here to remember one thing, okay, and here I have a, yeah, so this one thing you have to remember, that if there is any gift aid or pension contributions, then these bands will be extended, and so we will apply the CGT against these bands, okay, and there is a connection that I have to put into your, this income, this one also has to be compared, so I need to change that because I had different instructions earlier from the MC. This also, when you do the PSA calculation, the PSA also, for that you will compare, because what do we do normally? We compare the taxable income for PSA. We compare the taxable income to the upper limits of this one, and this one. We compare it to this one, okay? But if you have a situation where you're calculating PSA and there is also a gift aid or basic gift aid or personal pension contribution, which means that the grossing up has to be applied and the basic rate bands get extended. So let's say there's a 1200, 1500 thing. So the other instruction when you're in your notes file, I need to correct this instruction, which is that earlier I had said that you would always compare, because that's what the instruction given to me, that you would always compare it against the standard figures of these two, okay? So the question is, when you're calculating, why am I discussing this? That when you're calculating, so taxable income, as we can see, is relevant, among other things, it's relevant in at least two cases where we need to find out how much PSA is available for me. The taxable income becomes important. It's not based on A&I like the PA. The PA is based on A&I, but the taxable income, the PSA is based on taxable income. So taxable income becomes important, and I find out how much is my taxable income, and I generally have to compare it to these two, okay, the upper limit here and the upper limit here. And so if it's over this, then I get knocked out. So if it's below this, I get full 1000. So if I have like, this one is comparing it to 37.7, so if I have like 25k, then I get the full 1000 personal allowance, PSA. I get the full 1000 PSA. If it's over this but below this, then I have, let's say, 45k, then my PSA drops to 500, okay? And if I'm just recapping now, and you have to be comfortable with this, jumping between different areas of tax, because the more we can connect different ideas, the easier it is for us to remember any single idea. Remember that. So that's why I always try to connect the ideas as far as possible. So there is a connection here because we are looking at taxable income and we are trying to figure out what capital gains CGT rate has to be paid. And so there is another case where we did a similar exercise, so I'm bringing you back to that, which is for the purposes of determining the PSA. We did a similar exercise where we found out the TI and then we compare it. And so now if your income is over this, okay, then you get, basically, if you get like say 126k, then your PSA drops to 0, okay? It disappears once you go above this. So now what am I doing in this calculation? I'm just comparing this to these two numbers, all right? But the point is that in case there is any gift aid or personal pension contribution, you know that this will happen. So these numbers will become, so if this guy gives a net contribution of 1200 to gift aid, let's say, then the gross contribution is 1500, and then these numbers will become these numbers, right? So the correction that I have to provide is that the earlier instruction, I will change that instruction in your notes file, that earlier I had said that even if these numbers have been, these two have been changed to these two because of the gift aid contribution, you still have to compare TI to these two numbers. No, that's not correct. Actually, you have to compare TI to the, So this is more logical actually, that you compare it to whatever is the BRT upper limit for this guy, for this particular taxpayer. Because of gift aid, these two numbers have been changed to these two. So then you compare the TI to these two. Is this clear? To the expanded BRT, upper limits. So, or the extended upper limits. That's what you have to compare it to. And similarly, and so it's easier to remember also because the rule is the same for CGT as well. For CGT also, you will do the same thing. So if there is a CGT case where there is a case of gift aid, so they mentioned something about gift aid in a CGT calculation, then you know that because of the gift aid, this guy's, let's say there is a gift aid of 1200 to make our job easier, then you have to gross it up, you have to change these numbers to these numbers, okay? And then you will look at your taxable income and you will compare it to these numbers. If it's over this, then he will pay, if it's under this, he will pay 18%. If it's over this, then he will pay 24%. Even if it's over this, it's still, there are only two rates. So once you go over once you go over this one, what I call the basic rate tax, so it's a bit of a mouthful, but it's the correct terminology because we have to be very careful about using words carefully. Words must be used so that they have their precise meanings, and that should be what we intend to say. So basic rate of tax slab, upper limit. Higher rate of tax slab, upper limit, and so on and so forth. And the third one doesn't have an upper limit because it's infinite. All right, so that's basically what I wanted to clarify, just giving the clarification for PSA as well. And so also for capital gains, you know that you have to compare it to the extended BRTs, the extended upper limits for both. Okay, that's what you have to look at. In fact, in the case of CGT, only one is relevant because as long as you're below this, you get 18%. If you're above this, you get 24%. So the second one is not really important for cap CGT, but the point is to compare this to the here. So in this case is this. So taxable income. So when you're doing this kind of exercise, you have to compare taxable income to the extended upper limits in case there is an extension. If there's no extension, then the extended limit is the same as the original limit. Right. Okay. There's a mistake here. I need to write that in your notes actually. So this will not be 31st January 26. It's actually going to be 31st January 27. All right. So slide 15. Let me write a note here in your slides. Slide 15. Okay. Yeah, tax year 24-25 pay on, yeah, there's a typo which is coming in. So this one actually tax year 25-26, this will be, so the rule is actually 31st January after the end of the tax year. Okay, so 31st January after the end of the tax year. This language is not properly written here. That's why this mistake is also coming up, which is that, so in this case, a tax year of 24-25, we are now, we are going to be doing 25-26. So most of our questions are 25-26, right? So for 25-26, it's basically 31st January after the end of the tax year. So it has to be 37, okay? Not 37, but 27, okay? So the tax year is ending, the 25-26 tax year is ending on which date? April 5th, right? April 5th, it's ending on April 5th and 2026, and it's starting on April 6th, 2025. So after ending on April 5th, 2026, the next 31st January is 31st January 27. Okay, so there is a mistake in this thing. So there is a typo there, so please remember this. Okay, it's not 31st January. Now, there is actually one important thing you need to remember for this. This is basically, also remember this, I'm not writing it, it's there, okay? It's there on slide 15, which is very important, which is that if you have any kind of CGT that is payable, if you have a sale of a residential property, okay, especially one which is not your principal private residence, because that there the rules are different. But any kind of UK residential property sale, then you can't wait for 31st December. You can't wait for the next 31st January. Then the rule is you have to sell within 60 days. Okay, you sorry, not sell. You have to inform the tax authorities and pay the tax within 30 days of the completing the transaction, right? So if you have, let's say for instance, if you have any kind of sale within, let's say on say 1st of November of 2025, 1st of November 2025, so if you take just assuming every month has 30 days, so if you have full November, full December, so by 31st December of 2025, you have to inform the tax authorities about the money you made on the property sale. This is clear. So for payment of capital gains tax, please make sure there may be a question or 2 marks or 3 marks on payment date for capital gains tax. So the basic rule that you have to write is 31st January after the end of the tax year. Okay, so we can write this here. Actually, I'll write it here. So for tax year 2020, 31st January after the end of the tax year. But, okay, here, are you aware of this terminology, NB? Do you know what NB means? Have you seen this before? Have you seen this NB before? NB stands for nota bene, which means that please note. Basically what this means is please note. Okay, so this means nota bene. This means please note, basically. So note B, NB, what am I saying? I'm warning you on slide 15, the property rules. Okay. "60 days for property sales, property disposals." Okay. The 60 days rule for, let me just call it the 60 days rule for property disposal. So if there is a question on the payment dates for capital gains tax, your full answer has to be that the general rule is the payment has to be made and the return has to be filed by 31st January after the end of the tax year. So for 25-26, it will be 31st January 2027. But in case it is a disposal of a UK residential property, okay, as given here, then the 60-day rule applies, which is that the payment and the information has to be filed, the filing of the information and the making of the payment has to be completed within 60 days of completing the transaction. This is clear? So there is an exception for the case of property. So payment dates of income tax of CGT, you need to remember the 60-day rule for property, and the basic rule that it's 31st January after the tax year, after the end of the tax year. Yeah, okay, now here see, transfers between houses. We already mentioned this, if there's a transfer between spouses and civil partners. So in the UK they have a idea of civil partnership, which is basically you get most of the same tax treatment as married couples. So if that is the case, then we treat it as no gain or loss, okay? But let's say the husband transfers the house to the wife, okay? So let's say the husband bought the house in 2000, then in 2012 he sends the house to the wife, right? He gives the house to the wife, transfers it to the wife. So whatever is the gain in the value of the property, we don't register any gain or loss. Okay, so let's say he bought the house at 100,000. He bought the house at 100,000 in 2000. So later on, what will happen is, if you look at this, we can go back to our slide 7 to illustrate various topics. What is the slide here? 16. Okay, we're moving a bit slowly, but we have to explain these things. Capital gains is a very large, very big topic actually. So it's not surprising that if I wouldn't be surprised if we can't cover everything today. Yeah, okay. What is subsequent transfer? Yeah. So what happens is, suppose in 2000 you the husband buys something in the year 2000 for 100K. Okay, I'm not writing thousands. Okay, he buys it 100,000 at 100K. Then in 2012, he gives it to the wife at so buy. Okay, transfer to wife. Transfer to wife. Let's say at that time the value is 175. All right. Then what are we looking at later on? If the subsequent transfer, okay, so wife sells. So wife sells, let's say in 2017. At 2017, the wife sells it for 245. All right. So what will happen is that assuming there is no incidental costs of sale, there is no incidental cost of acquisition. Just to simplify the example, just to show you what will happen, the CGT for the wife will be, if you sold at 225, okay, not CGT but the chargeable gains, okay, so just the CG, so chargeable gains. So chargeable gains for the wife will be, as this is a simplified case where I'm not using the full pro forma, I'm assuming everything else is zero. Okay, then in this case it will become just the gross sales proceeds, because we are assuming no incidental selling costs, no incidental acquisition costs, then no additional capital enhancement expenditure. So it's just basically the gross sales proceeds minus the cost of acquisition. So what will happen is, it's not 245 minus 175. So the chargeable gains will be actually 245 minus 100. This is clear, okay? So the advantage that we are giving to the husband and wife transfer is that if there is a transfer between husband and wife, we assume there is no profit or no loss. But later on, when the wife sells the property to someone else, like an arm's length transaction, okay, in that case, there is going to be a chargeable gain, which is as if the husband had sold it as if he didn't make the transfer to the wife. So that's how it's going to be treated. Okay, so basically the husband-wife unit is treated as one unit for the purposes of these kind of transfers. So that's the net effect. So you just have to use the lower base. Is that clear? Okay, so let's try to move a little quickly. There is also a concept of rebasing. This is related to the idea of inflation indexing. That is, because the assets, real estate assets, a lot of this is property, so real estate assets tend to, and many assets, gold and all kinds of things, they tend to reflect inflation. So when you have high inflation, which you had in many, reasonably high inflation in many of the Western countries, so there is a concern about inflation indexing, because asset prices are going up just to reflect inflation. There is no real benefit as such. Are you aware of these terms called real rate and the nominal rate? You know this concept, right? So real rate is basically nominal rate minus inflation. Yeah. So basically we have to do this inflation indexing. So there's this rebasing concept. Okay, the rebasing is that we assume that if you had bought something, let's say in 1975, and you were still holding it in 1982, then when you sell that asset finally, let's say in 2017 or something, we won't consider your cost in 1975. We will just consider your cost in 1982. Okay, so it's like rebasing. It's in a way, it's kind of like the opposite of what we did just in the case of the husband-wife. Here there is no rebasing. But here we are using that 1982 rebasing just to reflect, inflation, high inflation, and basically asset price inflation, to reflect general price level increases. So therefore, that's not a real benefit because inflation has also gone up. So you're not making a profit in real terms. So you take the 1982 price as the base cost. That's what rebasing is. Here is an example. Okay, so he buys a thing in 81. So 81 is before March 1982. So when you get a value when you get a question like this, here you're supposed to use the 1982 rebasing rules, which is 31st. You have to remember this date, 31st March 1982. You have to remember this date, right? So they'll give you two pieces of information. So, well, at least on the cost price, they'll give you two pieces. So he bought it. So since he bought it before this date, this number will be ignored. So when you have a 9,500 sale, the cost will be taken as, in this case, the cost is this, but the cost will be rebased as 4,200. We will not take the 2,000 cost, we'll take 4,200. I don't know if it's very clear here, the background is too dark, but we are going to essentially take 9,500 minus the 4,200, which is the cost in 31st March 1982. So it's pretty simple actually once you understand what is being done. Okay, now we have these part disposals. So part disposal is basically where we have, let me see here where I have some notes on part disposal starting from slide 19. I think this should be correct. Okay, so you have an index there. Okay, cost, so part disposal is basically so the idea is very simple, is basically in terms of value. So we look at the current value of the asset and the parts of the asset. We look at current value, and based on the current values, we look at the proportion of the current value. So when you have a part disposal, so how are you going to find out the cost? Because you will know the gross disposal proceeds and the net disposal proceeds. That information will be given to you. But the question is, how do you figure out the acquisition cost? Because you didn't sell the whole property, you sold only part of it. So the way we are going to figure it out is we are going to take this fraction, A by A plus B. So A is whatever we have sold, and B is whatever is remaining. So we have to take the market value. And so when we can take the value, we can take assuming most of these are actually, most of the transactions given to you will be considered to be arm's length transactions, which means we will take the actual gross disposal proceeds as the representation of market value. So we will not try to force fit some kind of market value, because we take it as we take it as an arm's length transaction. So in this case, you take the gross disposal proceeds, A, and so you do this number, A by A plus B, and this is the original acquisition cost. So what this number tells you, actually the second term in this kind of expression, tells you, the second term is telling you what percentage in terms of the current values of the asset, in what percentage of the property has been sold, not based on like some other kind of metric, like you bought 5 acres and then you sold 1 acre, so 20% has been sold. No, you can't do that. You have to look at the value of what has been sold and the value of what is remaining. That's what matters. Okay, so this 5 acres, 1 acre, that's not important. So that's what we do. So you take an example here, okay? Yeah, don't take other information like size and all that, like I said, like 5 acres, 1 acre. Here's the thing. So you bought a big piece of land, and then you sold a part of it. So you bought the land at so you bought the land for 150K, right? Then you do some development on 5 acres. The land is 20 acres, so you take 5 acres. So don't get confused here by the 5 acres and 25 and 5 and 20 acres. So don't take 5 by 20, 25%, and don't take 25% of the cost of 150,000. No, that's not the cost. You have to look at the market values at the date of the transfer, at the date of the partial disposal. So what happens here? You sell it for 100K. Okay, so you sell 5 acres for 100K. All right. So in this case, your 100K becomes the A. All right, what we discussed earlier. So, and the balance of 15 acres is being valued at 5K per acre. So this is 5 into 15 is 75. So you sold something for 100K, and the balance is the remaining is 75K. So when you apply this formula here, your capital gain is going to be, this is your gross disposal proceeds minus, again here for these examples we are assuming no incidental selling cost, no incidental acquisition cost, no capital enhancement expenditure. So we are just looking at gross. So the standard formula here is just to simplify matters. We are in most of these examples, like the 1982 rebasing and the husband-wife sales, those kind of examples, we are always considering like the total, we are considering gross disposal proceeds and acquisition cost, and that's it. So here, what is the acquisition cost going to be taken as for the part of the farm that is sold? GDP, that is gross disposal proceeds, is this one, okay? And this one is going to be 150,000, which is the cost times, this is your A by A plus B. What is A? A is what you sold it for, 100,000, and A plus B is 100,000 plus 75,000 is what is remaining, all right? And so from there, if you do this, you'll get this number, 85 is 14,286. I've done it here also in your slide, in your calculation sheet, your slide 21, okay? Here's your slide 21 box in the the worksheet for capital gains, okay? You see here 150,000 is your acquisition cost, 100,000 is your part disposal, gross disposal proceeds, 75,000 is what remains, all right? Now this is actually a percentage. We can make this a percentage, and so what is this 57%? This is that A by A plus B. You see that A, this is the part that you sold by value, okay? And then this 75,000 is the value of what is remaining, or what you did not sell. So this, when you do this, the reason I calculated this number separately is that you can see that expression A by A plus B here, and then what is the applicable cost is this one, okay? So what happens? You take the 57% times the 150,000, and then you get the 85,714, okay? Which is the, in this case, what is 85,714? 85,714 is the cost of acquisition for that part of the land which has been sold. Is this clear? Right? So therefore your chargeable gain is CG will become the selling price, the 100,000, minus the chargeable minus the acquisition cost, which gives you your 14,286, which is tallying what you have with what you have in the sheet, in the slide. Is this clear? Okay, these are fairly straightforward things. Is once you get used to it and just practice it a few times. Right. Let's see another problem on that type. Okay, so you got 26,000. He bought the chargeable asset for 26,000. This is the original acquisition cost of the entire asset. Then he sells a part of it for 12,000. So this 12,000 is the A. This is the 12,000 is the A, and then there is an incidental cost of disposal here of 500. So you have to take care of this. You take out the 500 from the 12,000, but for the for A you have to take A as 12,000, not this. Okay, then you have this one. So if you look at this calculation here, then the value of the other 3/4 interest in the this is what is remaining. This is your B. This is your B. And then, so you have to calculate the chargeable gain, okay, here. So you see 12,000 is the A, and the 40,000 is the B, right? So what is this? So your sale, the gross, the net sale proceeds actually is 11.5. And what is the cost of acquisition? This is really the cost of acquisition. If you go back to your pro forma, the reason I'm mentioning that all the time is that we are assuming that there is no incidental selling cost. In this case there is, okay, but generally we are assuming here that we are assuming that there is no incidental cost of acquisition, there is no capital enhancement expenditure, Why am I mentioning that repeatedly? Because I want to kind of drive home the structure of the pro forma. In your mind, you should always have the structure of the pro forma, which is what I've given here. You see, this pro forma is what I'm talking about, this one. Why am I always saying? So many of these simplified example, all we are doing is, like in this case, we have this one, but most of the time we are looking at this, and we are looking only at this one, cost of acquisition. You understand? But in your mind, you should always mentally. So in an example where you don't have, let's say, allowable selling costs, okay, like you didn't have in the case of the March 1982 rebasing that we discussed for Alan, right? Whenever even if you don't have this in a particular case, and you don't have this one, and you don't have this one, but you should mentally always, that way the framework or the pro forma will get embedded in your brain, okay? Every time you do a calculation, you should think about all these parts. And most of the time, maybe there will be nothing for you, there will only be this one, and there will only be this one, okay? But you should still think about the whole framework, and you should assume that, okay, there is the allowable selling cost is 0, capital enhancement expenditure is 0. You should mentally write that in that way. Do you understand? So that will embed in your brain the idea that the overall pro forma actually contains all these elements. It's just that in a particular example, you are not seeing any value for capital enhancement expenditure, etc. So this is very important, because the pro forma is very important for capital gains, otherwise you'll make a mistake. So therefore, I want you to mentally do the full pro forma in every transaction, even when many of the elements are actually 0. But you should still mentally write a 0 against that and write that element in the calculation. So this actually is just the acquisition cost for the part that was sold. What is it? This is the A divided by A plus B, okay? And this is the cost of acquisition, 26,000. So this is your cost, and that is the A by A plus B. That gives you 6,000. So essentially your net disposal proceeds 11.5 minus, so this is your chargeable gain, 5.5. So part disposals, these are very clear. So these are all different types of calculations, but they're by and large quite clear, okay? Not very complicated. It's just that you have so many rules that it may take you some time to become clear about all the different rules and gets enough practice, and unfortunately we don't have any time. The exam is coming very soon, so that's the challenge, how to get ready in such a short period of time. So now we got some rules about chattels. Chattel basically means a tangible movable property, okay? So it's not a building and it's not shares. The reason it's not shares is shares are not considered tangible property. Although in the earlier days, you did have physical share certificates. In the modern world, very few countries have physical share certificates now. Everyone has moved to what is called digital book entry. So your shareholdings are all just digital entries in a accounting, a digital ledger somewhere. Okay, it just shows that you own these shares. So it's not considered tangible. So chattel is not shares. Certain types of chattel are exempt. Wasting chattels, like typically less than 50 years or so. So read the part on the book actually, because again, these are things which you see where I'm not going to try and go to the book because unless we have a problem, because we are very short on time. But read the book. So for chattels and exempt, so there are certain exempt chattels, and then there are some other kind of rules here. For non-wasting chattels, okay, wasting chattels, we have things which depreciate like less than 50 years of life, and then they depreciate. Those are generally exempt. Okay, now for non-wasting chattels, we have to remember this table. So it's like a matrix structure here on the On this side you have cost, which can be either 6K or less or more than 6K. And here you have the sale proceeds, which can be 6K or less or more than 6K. So the same thing here, but this one is costs. This is a sale proceed and this is costs. This is a gross sale proceeds. So if it falls in the first box, it is exempt, which means that you bought it for 6K or less and you sold it for 6K or less. Okay. Let me see if I have anything here. Okay, this is actually, we don't need, this can be there, that's okay. Fine, we don't have that, okay. I think I remember now what I did actually. Okay, yeah, okay. So this is what we have to look at. It's a box, it's a matrix format. So this one is exempt, very clear. And this one is also, these two, the diagonal here is clear. This one is just exempt straight away. This one is a normal CGT calculation. If you bought it for more than 6K and sold it for more than 6K. So these two are very easy to remember. Out of this matrix, these two are easy to remember. So the complicated ones are actually just the other diagonal here. This one is the complicated one, where you bought something for more than 6K, but you sold it for less than 6K. Okay, so in this case, obviously you have a loss because you bought it at more than 6K and you sold it for less than 6K. So you're going to have a loss, but so they'll give you that loss. But in the case of the loss, they will actually assume that even if you sold it for less than 6K, they will assume that even if you sold it for more than 6K, they will assume that the proceeds are the sale proceeds, and you bought it for more than 6K and you sold it for less than 6K, but they will still assume that you sold it for 6K. That's the complicated rule here, that they will assume that the proceeds are sold at, you sold it at 6K. Even if you sold it at like 3.5K, they will assume that you sold it at 6. This is one, and this one is, here the notation is not clear. It's taxed on the lower of A, the normal calculation of CGT, and B, this expression. Okay, so A and B. So you first do A and then you do B, and you will, the chargeable gain will be the lower of the two. Okay, so this is a more complicated rule, where your cost of acquisition is less than 6K or less, and you sell it for more than 6K. You bought it for less than 6K, but you're selling it for more than 6K, then you have this more complicated rule where you take A, normal CGT calculation like here, then you take B, which is this, and then you take the lower of A or B. So let's see some examples here. Okay, so he bought a painting for 3.2 and sold it for 6.6. Okay, so here's an example. So this actually is falling in the fourth, in the bottom left corner. In the bottom left corner, so we have to apply this rule. Okay, lower of A or B. So first let's do the normal calculation. He bought it for 3.2, so that means your cost of acquisition is this, and let's say gross sales proceeds is this one. Okay, 6.6. So your normal calculation of CGT is 6.6 minus 3.2. Then you get 3.4. This is your chargeable gain. But now we have to calculate the B, which is, what is B? B is 5 by 3 times the gross proceeds minus 6,000. So this one is 5 by 3 times gross proceeds minus 6,000, which is turning out to be 1,000. So we have to take the lower of the two. So in this case, you have to, this one is 3.4 and this is 1. So you have to take 1. Okay, so you just need to practice this framework a little bit. As I said, the first one diagonal is very straightforward, just logical. The other diagonal is a little bit complicated. But once you do it, you will understand the rules. So let's go through some of the other rules. Another one, okay? So he buys a table for 6.5K, sells it for 5.6K. That means this is falling in the top right corner, okay? Top right corner means you bought it for more than 6K, but you sold it for less than 6K. Okay, we have a 5-minute break. All right, let's continue now. Okay, quiet. Once we start the class, there should be no more talking. All right, so you see what happens here. He buys a table for 6K and sells it for 5.6, which means this is falling into the top right corner. Okay, bought for more than 6K and sold for 6K or less. So what is the rule here? The rule is that we will allow a loss to happen, but we will assume that no matter what you actually sold it for, we're going to assume that the sale proceeds were actually 6K. So what happens? Now you see this word deemed once again. That's why I've been emphasizing this word to you from the last semester itself. We came across many situations of deemed. This is a legal term, which means that something is not actually true, but we assume it to be true. Okay, so this is a case of deemed sale proceeds, because here the actual sale proceeds are 5.6, but because it falls into the top right corner, it gets governed by that rule where we assume that the sale proceeds are going to be 6K. So in this case, he bought it for 6.5 and he sold it for 5.6, but we will take the deemed sale proceed of 6K. We won't take this 5.6, we'll take 6K. And then we will look at there's an incidental cost of sale. So sale proceeds is 6, then this 250, so there's also the expenses of sale. So your net sale proceeds are this minus this, and then you have less the cost, and that will give you an allowable loss of 750. Is this clear? Because it's falling in the top right corner. Okay, these are the various types of examples. So here we have 4 paintings. If you see, we can actually do them here as well. We have the answer here. Okay, so let's look at the first painting. The first painting cost is 2,000 and the proceeds are 7,000. So this means that it's falling into the it's in the bottom right corner. So is it bottom right? Yeah, bottom left. It's in the bottom left corner. So it will be governed by that 5/3 rule. Okay, because you bought it for more than less than 6K and you sold it for more than 6K. So you bought it for 6K or less and you sold it for more than 6K. So in this case, we will calculate the normal gain first, which is sale proceeds is 7,000 and cost is 2,000. So there's a 5,000 normal gain. Okay, this is under the first calculation, which is the normal CGT. But then we have to take the 5/3 times the sale proceeds minus 6,000. Okay, so if that is the case, then we end up with the 5/3. This expression becomes 1667. So that's why 1667 is highlighted, because in this case the rule is to take the lower of the two, A and B. So in this case B is lower than A, so we take the B value, which is 1667. What is the next case? The next case we have is painting number 2, which is the cost is 8,000 and the proceeds are 4.5. This means it's falling under the right column, and it is the proceeds are 4.5, which means less. So it's falling under the top right corner. Okay, first row and second column. So it's falling in the top right corner. First row because the sale proceeds are 6K or less, and second column because the cost is more than 6K. So second column, first row, which means top right corner. So therefore the rule is that we will allow the loss to occur, but we will assume that the proceeds are 6K. So in this case, what do? We assume that, again, deemed proceeds. Remember this word, deemed proceeds. 6K is assumed, and then the cost is 8,000. So we have a loss of 2,000. And what is the last one here? Well, one of the last ones. So this one is, he bought it for 3,000, and he sold it for 5.5. So this is 6K or less sale proceeds, and cost is also 6K or less. 6K or less. So this falls in the top left corner, the first quadrant. Okay, the top left corner. So the rule there is that it's totally exempt, and that's what you see given here. That number 3 is totally exempt because both are less. Okay. And then number 4, let's look at number 4. Number 4 is what? He bought it for 7,000, which means it's in the second column, which is more than 6,000 cost. And it sold it for 9,500, which means it's in the second row because the sale proceeds are more than 6,000. So we have a normal calculation here, which is 9.5 minus 7. 9.5 is sale, this is 2.5. So if you look at the total figure, and this is how you add up the gains, right? You look at the net chargeable gains, you look at all the assets and you add them up, and you get this number. Okay, that's your net chargeable gains. So it's fairly straightforward. Again, all these are examples of different kinds of calculations. You just have to get used to them. Right, if there is a negligible value for a certain asset, you can make a negligible value claim. Well, actually, this is strictly not correct. It's 0. That's why you should refer to Melville. Let's look at Melville 278. So the page number reference is off by two pages. Okay, so maybe I should write this so that you can understand it. Then I can figure it out, but still. Which slide are we on here? Slide 30. So let me write the number on slide 30. So let me just write it here. On slide 30, okay. Page ref add 2, okay, or let me just write page ref plus 2, okay. That means that when here it says 276, for our book actually what it is 278. So since this is a 16 there, 16 offset means that I have to add 16 to the actual page number to come to the meta page number, which I will do here. So I need to go to 278, if I'm right, 278, then that will become 284 to 94. So let me go to 294. Here, 294. Now, if you're doing it in a separate Adobe Acrobat file, the system may be different, but I always use it, I always open it in the browser. There is, okay, this is actually 270, 278. And what is the thing we're looking for? Assets with negligible value. Now the information given here is strictly speaking not correct. It's not assumed that it's sold at 0. Basically what it is that if you have an asset with a negligible value, you can make a negligible value claim, okay? Then what we assume is that it has been disposed of at its the current negligible value and reacquired at that current negligible value. So you will initially trigger an allowable loss, but later on if you sell that asset, if you look at it this way, here's the example, which shows you I'm not sure if this is very important, but since it's been mentioned in the slides, we have to assume it's important. We have to know this rule. Okay, here's an example, but it's very simple. That's why the textbook is still helpful in many ways. That let's look at this thing. So it's not assumed that it's sold at 0. It's assumed that it's sold at the negligible value and immediately reacquired. Okay, so this one you have to be a little careful. Read the book. Okay, so the full picture is not given here. So 7:30, I will say read book. Very important because that gives you the true picture. This one doesn't give give you the true picture. Here's the Gloria example, negligible value. Here's, see this example. What happens? She has 1,000 shares. She bought it for 7,000, but now because the company must have got into trouble and the shares were suspended, trading is suspended, and then she's claiming that the share value is 10 pence. Okay. So if it's 10 pence, then 10 pence is like 0.1 of a pound. Okay, and so she bought it for, so she bought 1,000 shares for 7,000. So she bought it for like 700 pence, right? 700 pence. So UK prices are always quoted in pence, not in pounds. So pence is like 1/100th of a pound. So this is now she bought it for £7. And now it is 700 pence, and now it is 10 pence per share. So the claim is accepted by HMRC. Now what is the then? We assume that it was sold and reacquired at that price. So, but when you sell something at 10p per share, so what is the disposal value? This 1,000 shares at 10p is 100 is the disposal, the gross disposal proceed. And what is the cost? The cost is basically whatever you paid for it is 7,000. So you generate a loss of 6.9. But your carrying cost, remember, you're not actually making a sale. You're just generating some kind of a deemed loss, okay, which is allowed because here there's no actual sale happening. There's no disposal actually happening here. So this is like a deemed disposal. There's no disposal happening. It's just that you make a claim that this asset has now got a negligible value and HMRC agrees to it. In that case, they allow you to have based on this deemed disposal, you have a loss of this 6.9, okay? But if you can actually sell the shares, you're still holding on to the shares, okay? And that's why it says that it is assumed that dispose of its current value, which is a negligible value, and immediately reacquired at that value, okay? So what that means is that in future, because you're still holding on to the shares, when you actually sell the shares, that time your cost of acquisition will be taken as this, not this. Your cost of acquisition will be taken at this. So if you sell it for a high figure, let's say 9,000 or something, the government will get back the tax, the benefit they gave to you, they'll get it back because now they're counting your cost of acquisition as 100. So if you sell it for 9,000, then the gain is going to be 9,000 minus 100. You understand? Okay, so that is what happens in the case of assets with negligible value. We normally don't get questions on this, but it's better to study it. Everything that is there, you should study it. Okay, so be careful about the slide. The information is not quite clear. Okay. Shares and securities for individuals. Let's look at it how we have. Certain types of things are exempt. Listed government securities, qualifying corporate bonds, individual savings account, which as you see from income tax as well. Okay. Now, how do we identify the cost of shares? Valuation of quoted shares. Okay. If the unconnected parties means that this is a arm's length transaction. Okay. So generally we assume there's arm's length, unless there's some information in the question that tells us that it's not connected. So we can use if it's unconnected, we can just use the value, whatever the value was, the transfer was, because it's assumed to be at market. If connected, we have to use the market value. And how do we find out the market value? There will be quotations given to you that this stock price was quoted at this price. So usually they'll give you the bid offer price, okay? So what we call bid offer. Here, what do we call bid offer? Here, this is where I've given all this bid offer. So here you need to understand actually, well, we don't have time for all these discussions. But whenever you look at a market price, okay, whenever you look at like, if we look at like Forex Live or something like that, at any kind of, hopefully we have some two-way prices. If you look at any kind of foreign exchange quotation or something like that, or a stock price, even a stock price quotation, we it's taking a little time to load. But anyway, you will see that everywhere you go, you will have this kind of a, so if you have something like this, it's not really coming out properly. Anyway, it's not really working out very well. Okay, never mind. I'll just mention it here. I'll just show you here. So whenever you go, okay, if you go to the bank, you'll see that the bank is quoting prices like this. So right now the prices are much lower. Okay, so right now the price is probably like 682.50 and like 6.85. Just make it slightly wider. It's probably not that wide. Okay, so we can make it like 683, 686. Okay. So the dollar versus CNY is quoted like this. Okay, so this one according to the convention. So in the currency markets, we have different conventions for different currency pairs. So you can learn about that. We are covering that in the finance module. So you have access to that. You can download the lectures for that as well and watch them later on. During your summer, you need to know about the financial markets because it's quite strongly connected to accounting. So basically what you have is a 683, 686. So if you go to ICBC, you'll see they're quoting prices like this, okay? So there is the bid and the offer. This is the bid and the offer. So this is the rate at which the bank will buy dollars because dollars is the base currency and this is the terms currency, okay? So this is telling you 683 and 686 is telling you how many RMB per $1. You understand? How many RMB per $1? Okay, so there is a CNY. In mainland China, we use CNY as the code, and in CNH is used in Hong Kong. So the same RMB which is cleared in Hong Kong, there is a code called CNH. Okay, this is CNY for mainland China, and Hong Kong is CNH. So you should learn about all these things. So anyway, so how do we find the mid price? We basically is what they're doing is the rule that they have given is they have taken the lower price. I've just shown you the rule here, okay? They have taken the lower price. You can see the color coding, I think. They have taken the lower price plus the difference between the higher and the lower divided by 2, and that's basically it, okay? Or you can also just take the average of the two. That will give you the same result, okay? So anyway, so that's the rule. So when you get, so when it's actually when you need to use the market price information will be given like this. The shares were quoted at 683 pence and 686 pence, like that. Okay, so they'll be the prices will be given like that, and like here, see, are quoted on the stock exchange at 230 pence to 270 pence. That means that this is the two-way price. This is called the two-way price. The market makers two-way prices, because one price for buying and one price for selling. So here what this means is that this 230 and 270 means 230 is the bid and 230 is the 270 is the offer. Okay, so these are called bids and offers. This is called the bid-offer spread here. Okay, so here you can calculate the bid-offer spread as well. Okay, bid-offer spread is just the difference between the bid and the offer. So these are not required for your tax purposes, but this is important market knowledge for you as well. And you just take this, whatever they're using, half up rule, okay? That gives you what we are calling the mid price, okay? This actually gives you the mid price. They haven't called that, but you have to basically use the mid price, okay, by using this rule. So it's very simple. Now this is more complicated. Identification rules of shares. So when you're selling some shares, maybe you have a lot of share transactions, you bought some shares, you sold some shares, and all that, right? So though there are a set of rules for matching shares. Now this, you don't have to really worry about it, but you should learn about this term. I don't have enough time in the class to discuss all this, but share classes are very important. Let me see, which is slide 34. I don't have anything mentioned again. Yeah, so this one, okay. So share classes, actually, they should be under slide 34. I'm mentioning it here. And I think you need to know about this, just like you didn't know about transfer pricing, you didn't know about arm's length transactions. These are all things you need to know. As I said, accounting, finance, it's all the same. Accounting, finance, and law, they're all so closely connected that it's all one subject. So it's better for you if you study from different dimensions, from a multidisciplinary perspective. So what are we talking about? Slide number 34. So let me make this slide 34. It's important for you to know about share classes, okay? I'll give you a simple, very important story relevant for China. So you know that until now, even today, I think Alibaba is the biggest IPO in the world so far. So they raised $26 billion when they raised money. Now the SpaceX IPO is coming up, so SpaceX IPO will probably be much bigger than Alibaba, but so far Alibaba is still the biggest IPO ever, right? You know about IPOs, initial public offerings, when the company sells shares to the public and they go public for the first time, right? So those IPOs, that now this share class, so the biggest IPO so far is Alibaba, which is 26 billion on the NYSE. But now, do you know why this, as Chinese students, you should know this. Do you know why Alibaba chose to IPO on the NYSE and not in Hong Kong? They could have also sold shares in Hong Kong. They would have been okay. They would have also raised enough money in Hong Kong. Of course, the US market is much bigger and deeper, but there was another reason why they did not IPO in Hong Kong. Do you know that? Do you know that? Okay, the reason is share classes. At that time, Hong Kong did not allow special share classes. So what do we have? Why do we have share classes? So far, you've only heard about ordinary shares of equity shares. All shares are one class, okay, one share, one vote, okay. All shares are one share, one vote. But what you have is basically super shares. What happens is that you have super shares, means that you have massive votes. So super shares maybe, let's say, example, okay. To take an example, like 25 million votes per share, okay? So all these guys like Mark Zuckerberg, how is Mark Zuckerberg maintaining control of Facebook or Meta? Because he's not a majority shareholder, but he just has the he's got the shares of the right classes. So they create a separate class of shares, like super shares, where each share is like 25, I'm just giving an example, 25 million votes per share. So the main thing is the voting rights, right? Remember that in equity shareholders, what is the special characteristic? Other than other things, one important characteristic is voting rights. Do you understand voting rights in corporations? Yes? You have AGMs, you vote people in, you vote for the managing director, yes? So voting rights is a very important part of equity shares. So voting rights, the meaning of different share classes is that you have differential voting rights. You still get the same dividend. Everyone gets the same dividend. But if you are owning own these kind of super shares, then you will get high number of votes per one share. But everybody else with ordinary equity shares, they have only one vote, one share. But you get like 25 million votes per share. That's how Mark Zuckerberg is controlling Meta. That's how the founders of Google are controlling Google. So this is what Jack Ma and company wanted to do, Jack Ma and the other founders. They wanted to retain control of Alibaba even after the IPO, when they would have sold many shares. In Hong Kong, under Hong Kong law at that time, they did not allow for separate share classes. That's why they went to the US and did it, because they didn't want to lose control of the company, okay? Now Hong Kong has come around, Hong Kong has realized they're losing business, so now they have changed the law. But at that time, the law was not there, so that's why they IPO'd it. So it's a little bit, I lost a little bit of time, but it's important for you to know these stories. Okay, so business connections to all this. So share classes, so that's why we just look at the same class of shares, because the prices can differ for different classes of shares, because you have differential voting rights. Some shares have many shares, votes per one share. So that's why you look at the same class of shares. So I just Okay, so what is the rule? Match it when you sell some shares. Where are you going to? How are you going to figure out the cost of acquisition of those shares? That's where these rules come in. What is the cost of acquisition? So first look at whatever cost shares were. You sold some shares, okay? So you know you sold some shares today. You sold some shares today. First find out, did you buy any such shares today of the same class of the same company? Well, maybe not. Okay, if there is something, then you adjust that. Okay, so suppose you sold 3,000 shares, you need to adjust. Okay, so maybe you bought like 2,000 of the same shares, so then you adjust against 2,000. Now you have to adjust 1,000 more left to adjust. Then you find out if there is any shares of the same class bought within the next 30 days following the sale. If you did you buy anything within the next 30 days? And then the third one is what is called the Section 104 holding, which is the share pool. All right, we'll see. Which once you look at the calculation, you will understand what it is. Okay, share matching examples. Page 197, 297, which means 299 for us. Let's look at example 1, 299. So 299 means actually 315 for us in here, because that will take us to page 299 is the actual page number. Yeah, this is 298, 299. Okay, so there we are. Okay, so here we are. No, maybe we can keep it here. I hope you can see everything. Right, okay, so that's different for now. Nazir made the following acquisition and disposal. Okay, so no further shares, against which of the acquisitions each of the above disposals be made. So I'm going to make it a little smaller so we can see everything in one view. I don't know if you can still see the numbers. Example 1 we don't need to see. We are just going to look at, we don't even need the date. Okay, the first date is 5th of June 2015, and and how many shares. All right, now we can see most of the information. Can you read the numbers on the last bench? Sybil, can you read the numbers? Yeah? Okay. So see, 5th June, he bought something, okay? We're going to start with the sale first. So the first sale is May 2016, 17th May, okay? So he sold 800 shares. Now, did he buy anything on 17th May? The first rule is use the purchase date, okay? So look at this, look at the solution here. So 17th May, he sold 800 shares. First, you apply the same day purchase. 17th May, he bought 500 shares. So we can take out 500 from here. So we can apply 500. I still need to account for 300 more shares. Then 17th May to 9th of June. This is within 30 days. Okay, 9th of June, acquired within the next 30 days, 200 shares. So I had to take care of 300 more shares. I got another 200 taken care of. So that's gone. Now I need 100 more to be adjusted against the pool, right? So the 100 is coming from the Section 104 holding. Section 104 holding is just your existing block of shares which you're holding, against which you have not made any adjustments. Okay, remember, when you're making an adjustment, you're not actually selling those particular shares, but you are just taking the value of those shares as a acquisition cost. So the 100 shares from the 7 that form the 100 shares. So there are how many? What is the shares? What is the 104 holding up until now? Up until here? Well, it's actually only 3,000 shares you had. Okay. So those 3,000. So from that 3,000, you will take out 100 shares. Okay, and then that will leave 2.9K in the holding. Okay. So after the 7th disposal, so we need to keep track of this because there are more disposals. Next disposal here, you see, 13th March. Okay, did you buy anything on 13th March? Nothing. Okay, so did you buy anything within 30 days of 13th March? Yes. On 28th March, you bought 1750. So I need to adjust for 2,000 shares. I need to find a matching cost basis for 2,000 shares. I already found 1750 because I will adjust the so I already found I just need to take care of 250 more, right? So I take the first and acquired on the second by the second rule. Now I need to take the 250 against the remaining. Remember last time here, 2,900 was left from the section 104 holding, and so I will take out 250 from the 2,900 shares, and that means how much is remaining in the holding? 2650 is left in the holding. And there's one more disposal here. There's one disposal on October 24. Okay, nothing is bought on the same day. So when we look at the October 24 disposal, right here, yeah, here. So you can see here October 24. You can raise it a little bit. October 24, what are we doing? The 1,000 shares we sold in October 24. Well, we still have, well, there's nothing bought on this date, and nothing bought within the next 30 days. So we just have to apply the third rule, which is the section 104 holding. And how many shares do we have left there? It's 2650. So out of that 2650, we take out 1,000 mentally, okay? We take out, adjust 1,000 against the cost of the shares here, okay? So 1,000 shares again. So the 104 holding becomes, now the 104 holding will become 2650 minus, it will become 1650, right? Yeah, there you see that. So what is left in the 104 holding is 1650 because we have adjusted 1,000 shares out of the 2650 left in the holding. Is this clear? Is this calculation, are these calculations clear, what I've done? Yeah? Okay, so you can look at this example once again and revise all this stuff. You have to revise all this stuff, otherwise there's so many complicated rules you will not be able to manage. Okay, so now here, next is, okay, identification, another example of shares, okay. So what is he doing here? Number of sales. So we only have to worry about the sale. We start with the sale because the sale creates the problem. So you got, okay, you sold some shares, we know how much you sold it for, but what should we take as the acquisition cost of these shares that you sold? That's where we need all these rules, okay? So did you buy anything on that day, 15th April? No, we didn't buy anything on that day. Did you buy anything within 30 days of the sale? Yes, okay? So you bought 800 shares on 28. So the out of the 3,500 that we need to, kind of allocate the cost for, 800 of the shares will take the cost from the sale on this day, okay, for 6,400. Now we still have to take care of 2,700 here. So let's see the calculation here, all right? Let's see the calculation. This is the information already given to you about the holdings. This is all your section 104 holding, okay? Until you come to this date, this is your section. Until 20 May, before 15th April, this is all your section 104 holding, which is all the shares which you have, okay? Now here, so what is in the share pool? Let's see what happens. So let's see here. Okay, yeah, let's do the whole calculation here. Let's see. So you sold 3,500 shares for 36,000. That is information already given to you before. 3,500 is sold for 36,000. Now, did you buy anything on the same day? No. Did you buy anything in the next 30 days? Yes. You bought 800 shares, so we take out 800 from here, okay, and the cost of that is 6.4K as given, all right. So we need to take care of this 2,700 more because we've sold 3.5. I only took care of 800, so the 2,007 has to come out of the share pool, right? The 104 holding. So what is the 104 holding? Is here. This whole block is the 104 holding. So you have 4,000 at 8,000 value, you have 1,800 shares at this value, and so on and so forth. So you get a total of 7.3 shares at this value, right? Now what are you selling? This is fairly straightforward. This is not based on value, this is really based on the kind of the equivalent of size or proportion. So it's very logical. You have a share pool where you have 7,300 shares, and the cost of that is 30.25, right? So if you have 7.3K and your cost is 30.25K, and now you need to adjust, you already took care of 800 out of this, so you need to take care of further 2.7. So you have to find out what is the proportion of 7.3 represented by 2.7? So you can see here, very simple logical calculation. So the cost of the whole block of 7.3 is 30.25, and you are taking 2.7 out of that block. So you take 2.7 by 7.3. That's the percentage of the shares out of the pool that you're taking. So therefore, the cost of that 2.7K shares should be the percentage of 2,500 divided by 7.3 times the cost of the pool, right? So that gives you a figure of 11,188. So you got two cost numbers. So this is your net sale proceeds, and now we're talking about acquisition cost. Acquisition cost, this one is for 800 shares is this one, for this 2,000 shares is this one. Okay, so your net is 36 minus this gives you 18.4. And then you just have to make a note on what is remaining in the share pool. What is remaining is 4,006 is actually 7.3 minus 2.7. And the remaining value is 30.25 minus the 11,188. That gives you this one. So you make a note of what is left in the 104 holding, how many shares and at what value. Is this clear? Yeah? Okay. Bonus issues and rights issues, again, this is further telling you how finance is so intimately connected to accounting. You come across with so many finance concepts. Okay, so bonus issues are free shares given by the company to existing shareholders. So we just include it in the same pool at a zero cost. And the rights issues are again issued, rights are given to existing shareholders. You get an opportunity to buy the shares at a favorable price. Okay, so this is called a rights offer. So sometimes companies will make a rights offering, and they will give the share, they will give existing shareholders a preferential pricing for buying new shares in the company. So bonus issues and rights issues, how in this case we will just include it at the price paid for them. So here's a bonus issue. You have to watch out for this language. You need to understand this language because in the exam it will not be explained to you. This kind of language will be used and you need to be able to understand what it means. So you need to learn this. This is a good thing to learn. It's actually finance terminology, and that's what you need to pick up, okay? Which is, so he got the acquisitions of preference shares, okay? So he bought all these shares, okay? So he's got, this is his 104 holding, section 104 holding at this point. Now January 2018, the company makes a 1-for-4 bonus issue, okay? So this is the language you have to watch out for. 1-for-4 bonus issue means that for every 4 shares you're holding, you get 1 extra share for free. 1-for-4 bonus issue means bonus shares are free. You get extra shares for free, but it's like, it's like buy 4, get 1 free. Do you understand? We all understand what is meant by buy 1, get 1 free, right? In McDonald's, you can go and buy 1, get 1 free, 1 plus 1. So this is almost like that. So every 4 shares, so it's like if you have 4 shares, you get 1 share free. Okay, so that's how you have to figure out the language. So it will only say 1-for-4 bonus issue. It will not explain anything in the question. You have to figure out how many numbers that means. So how many shares does this guy have? So you'll see that he already has 900 shares. Okay, so 900 shares, so he will get, for 900 shares, you divide it by 4, okay, and then you'll find that he gets 225, okay. He will get 225 fair shares for free as a bonus, okay. See if I did that number right. Yeah, it's 225. So 900 by 4 is 225. You will get 225 shares for free. Is this clear now? You need to make sure you understand the language, okay? You're holding 900 shares when the company makes a 1-for-4 bonus issue. That means the question is, how many bonus shares did you get? You got basically the number of bonus shares equal to 900 divided by 4. Because for every 4 shares you're holding, you will get 1 bonus issue, one bonus share. Is this clear? This language you need to understand. So what is he getting? So this is his 104 holding at this point. Then he gets a bonus shares of 225. This is zero cost addition. So his 104 holding becomes 1125, same cost. Now what does he do? He sells 450 shares. He sells 450 shares for 4 sterling each. Okay. Yeah, per share 450. So the price, the disposal value, the gross disposal value is 640. No, in this case, the sale of value will be this. The disposal value, gross disposal proceeds is 1800. Okay, we can actually call it net because there's no incidental selling cost given here. So he sold the 450 shares. He sold at 1800. Now the question is, what is the cost of the shares? How do I get this 640 number? Again, I have to use the same concept. I have to apply it against the existing the 104 holding. So what is my existing pool here? I got 1125 shares at a value of 1600. So I'm taking 450 out of that mentally. So I'm adjusting 450, adjusting against 450 of that. So I have to take 450 divided by 1125, okay? That is like your proportion. And then the total value of the block is 1600. So you take that percentage and you multiply by 1600 and you get 640. So your cost of the shares will be taken as 640. Is this clear? Yeah? So then you have sale of shares is 1800. And then cost is this, and so chargeable gain is 1160. Okay, so let's see here. Now you see more examples of shares. Right. So you see, these are things she bought. I'm not going to read out everything there. Okay, so you can see all this stuff. Okay. Now now again, this language you have to be clear about in the language of rights issues. So as of now, before January 15, her Section 104 holding is this. So she's holding how many? She's holding 2,000 shares here, then 3,000 shares here. Okay, so she's holding 5,000 shares. What does the company do? The company makes a 1-for-5 rights issue. 1-for-5 means that for every 5 shares you're holding, you get right to buy 1 additional share. And it says that Yvonne decided to buy all the shares offered. Okay, so she took the 1-for-5 rights issue. She bought all of them offered. So and then she sells half the shares at 180. Right. So you see the calculation. You'll see that in this case, what happens? We can make this a little bigger actually because the numbers are not big enough. And you can see the full thing here. So that's her pool. She's got 5,000 shares at 4.8, and then she gets a rights issue. In the rights issue, she gets, this is the number you have to figure out, because the rights issue, terms of the rights issue are a 1-for-5 rights issue. That means for every 5 shares you're holding, you will get 1 right to buy an additional share at a discounted price. So you get the rights issue, and I think the rights issue given is at £1 per share or something. Yeah, £1 per share. So that's why we write the £1 per share. So we write the acquisition cost of the rights issue block is 1,000 shares at a cost of 1,000. So now your share pool becomes 6,000 shares at a cost of 5.8. Then you sell 3,000 shares. Okay, and your sale of shares 3,000 into 1.8. This is your net disposal proceeds. And what will be the acquisition cost that we have to take? That's the question mark. And this is how we do it. Okay, we are going to apply it against the Section 104 holding. And we find that the Section 104 holding essentially is just, we have to take out 3,000 shares mentally. We have to adjust 3,000 shares against a block of 6,000 shares. So it is 3,000 by 6,000 into whatever is the value of the block, which is 5.8. This number 2.9 is the your deemed acquisition cost of the block that you of this kind of the number of shares that you sold. So 2.9, and so you take the sale proceeds of 5.4 and you deduct 2.9 and you get a chargeable gain of 2.5. Is this clear? Fairly straightforward actually. So let's see how much we can cover. Now we have a slightly more complicated set of rules. PPR relief, principal private residence relief, chapter 21, you can refer to that. Okay, PPR means that it's a principal private residence. So there's a special tax treatment given for that. So generally the idea is that we tend to go easy on the taxpayer for their principal private residence because everybody needs a place to stay. So we should not penalize them. Okay, so I have to stop here at, okay, so yeah, it's inevitable that we could not cover the whole of capital because it's a huge chapter. So we'll have to continue with the next session. Let me just quickly make a note before I go to the, so I stopped here at the beginning of this. So start of slide 43 is where we stopped. Let me make a note of this. And so we are in week 6 now. We are week 6. We are group 1 T7. We are in T7. Okay, we can write. Okay, no problem. Slide 43. This is where we have to continue from next time. So please try to study this on your own anyway, to try to get ahead a little bit, because this is the problem, that there's so much material that one can't really cover it everything in the class, is because one has to also explain things properly. Anyway, so let's move on to the attendance. Now before that, let me stop the recording. Maybe I should just pause the recording because we'll have some questions after the class, so I can renew the section.